Federal Reserve's Vice Chair of Supervision, Michael Barr, said on Tuesday that the Fed is exploring the use of reverse stress testing as a tool to make banks more resilient. This comes as the central bank examines ways to reform bank culture in the aftermath of Silicon Valley Bank's failure in March. Barr's comments were made a day before Fed Chair Jay Powell testified to Congress as part of his semi-annual monetary policy report. While investors remain focused on the Fed's next move on interest rate hikes, lawmakers have been focused on the fallout from the collapse of Silicon Valley Bank and other banks this spring. Reverse stress testing means looking at a bank and asking, what would it take to break this institution? Instead of thinking of a stressful scenario and then seeing how it would play out on the balance sheet of the firm, Barr said that reverse stress testing could be used as a tool to help supervisors recognize more exogenous issues that could go wrong instead of patterns from past regulators that have been trained to catch. Barr noted that the regulators were caught off guard by the speed with which Silicon Valley Bank lost 85% of its deposits, an event that happened in just 2 days compared to prior runs that lasted 10 days or more. That's not a pattern people had seen before, said Barr, and we really have to work harder at the kind of things where there are patterns that we haven't seen before. So I think it begins to help us supervisors understand the ability to look around the corner and kind of predict what's coming. Barr also said that the Fed is looking inward as to why it's slow to move on supervisory issues. We've also begun to look more at ourselves and think about our own culture as an institution, said Barr. One of the things that not only our SVB report, but also the report on the global financial crisis and reports earlier than that found that we tend to have a culture that makes it difficult for the institution to act quickly with respect to supervision. Now, the Fed flagged and was well aware of Silicon Valley Bank's issues in advance, but unfortunately was just too slow to act to enforce their infractions. Supervisors found deficiencies in the bank's liquidity risk management near the end of 2021, resulting in 6 supervisory findings related to the bank's liquidity stress testing, contingency funding, and liquidity risk management. In May 2022, supervisors issued 3 findings related to ineffective board oversight, risk management weakness, and the bank's internal audit function. By November of 2022, supervisors delivered a supervisory finding on interest rate risk management to the bank. And then in mid-February 2023, just weeks before the bank failed, Fed staff had highlighted SVB's interest rate and liquidity risk and said they were actively engaged with SVB. Silicon Valley Bank failed because of the textbook case of mismanagement by their bank. This was written by Barr in a report late in April. Its senior leadership failed to manage basic interest rate and liquidity risk. Its board of directors failed to oversee senior leadership and hold them accountable. And Federal Reserve supervisors failed to take forceful enough action as detailed in the report. Now, if you're in need of an experienced commercial real estate broker, I can be reached at 281-222-0433. I appreciate your time and have a good day.